Coming in at number one of sentences I didn't wish I ever had to say, I've been thinking a lot about Andrew Yang. In particular, I've been thinking a lot about this TikTok.
The bottom 50% of Americans own zero stock, and the bottom 80% own 8%.
And he's not wrong. The stock market isn't really accessible for a lot of people. It's not something everyone thinks about, but it's something that everyone has, at this point, the ability to think about. And I completely recognize the privilege in that statement. I really want to help bring those skills to as many people as possible and who are interested. To be honest with you, the stock market seems a lot scarier than it actually is, especially with the amount of resources out there right now. And I'm really lucky. I've worked in finance. I've actually learned to understand the stock market in a way that I never thought I'd be able to do. And at the end of the day, a lot of the basics are what gets people really far. So let's start talking about them. First, let's talk about resources. There's a lot out there to start learning about the stock market, and there's a couple disclaimers I'm going to throw out there as well. The first thing I did when I started learning about stocks was I read some books. In particular, I read Rich Dad, Poor Dad, A Random Walk Down Wall Street, and Stock Investing for Dummies. And potentially even easier than all of that, there's a lot of free resources online. Whatever broker you use should offer you some sort of resources or news or stock advice that I think is always a great starting place to learn. I'll link some articles down below that are just how to get started, what the stock market is, and things like that. But my go-to place for financial advice, and I know a ton of people on Wall Street or in finance who keep this site open all the time, is Investopedia. As we're talking about resources though, I do want to give an itty-bitty disclaimer, which is that anyone who is picking single name stocks on the internet is probably not a licensed financial professional. As someone who is licensed, something I'm very cognizant of is the fact that I actually can't give single name stock advice, nor would I ever really do that. If someone's picking single names for you, the chance that they're licensed or actually involved in the industry is pretty low. Just something to keep in mind as you go forward and start thinking about stocks and the market as a whole. That's not to say single name stock picking is always a bad idea, but for most average investors, I would say that is not the way to start thinking about the stock market. I'm someone who's licensed, so I had to take licensing tests that taught me a lot, but a lot of that stuff that you learn about or hear about in big stock movies, trading options, iron condors, DCFs, none of that's really necessary for an average person to start working with the stock market. And thinking about the stock market and saving, if you have other goals that you're trying to meet actively, say you want to buy a house next month, or you're still trying to save up an emergency fund, the stock market isn't where you should put that type of saving money. I put money into the stock market that I know I won't need to access for at least another year. And then you can open a brokerage account. There's a couple things it's going to ask you. There's things like your name, your social security number, and your income. Things that will let the platform know what level of risk you're willing to take. And here are some questions you should ask about your brokerage account. What services am I getting? What services do I need? Are there any fees associated with the individual account itself? What type of account is it? How much time does it take to move money in or out? And who do I contact if I need help? I think those are all good things to have in mind when you're thinking about your brokerage account. Before you start putting money in though, let's talk a little bit about risk. The stock market is inherently risky. You are not guaranteed your money back, and while a lot of people can use it to generate big returns, people also lose out on the market. Something I think about is, do I need this money today or tomorrow? And if I did, I wouldn't be putting into the stock market. For example, let's talk about 2008. In the 2007-8 crisis, a lot of people lost a lot of money and cashed out at a major loss. Obviously, there are companies that went under, but if you had been invested in the major indexes, a couple years later your money would have returned to normal and actually exceeded where it was going into that space. And we can say the same thing about earlier in 2020. A lot of people lost a lot of money in the market, but if you didn't cash out today, you would be doing just as good, if not better, if you were invested in the major US indexes. So this is something to think about when you think about your risk and putting money into the market. A lot of people talk about risk in numerical terms, but the way I like to think about it on a baseline is, can I sleep at night? And another big tip I think for this one is don't check your portfolio every day. And so now you're here. You have a brokerage account, you put some money in. There's a couple of other considerations. The biggest one is, what do you buy? Again, I'm a financial professional, so I'm never going to tell you to buy single names, but I can tell you a little bit about how I think about my personal portfolio. Number one is I don't do a lot of single name stock trading. There's a couple names I do have in my portfolio, and if there's this company I feel a lot of conviction in, sometimes I'll buy their stock. But in general, I mainly just put my money into the indexes. Someone once put it to me this way: your stock portfolio is a salad. Single name stocks are like croutons. They're fun to have, they add a little bit of crunch, but at the end of the day, what you need to focus on is your indexes and all of that to make up the lettuce of your portfolio. Did that make sense? Yeah. Single names are your croutons. So when you're talking about an index, there's three that are most commonly referred to in the US. There is the Dow Jones Industrial Average. That's often what we talk about when we talk about the US market gaining or losing points. There's the NASDAQ, and then there's the S&P 500. They're all composed a little bit differently, but they track the general US market. And most people buy variations of those three different indexes. And when we talk about something that's going to track the market, usually people are referring to one of two things: an ETF or a mutual fund. They operate similarly, but they are a little bit different when you're trying to talk about buying stocks for the first time. You can think about both like they're baskets or collectively managed funds that track a bunch of different stocks, so you yourself don't have to go out and buy every single name in the S&P 500 and weight them yourself. I'm going to put a link down below that explains it in more detail, but the way you can think about it is this: ETFs are like individual stocks themselves. You buy it and you have to buy it at a certain price. A mutual fund has something called a net asset value, and you can buy it in partial shares, and you can split your money between the two of them. Just because you bought something once doesn't mean you have to ever buy it again. They both can have minimums in a different way. Again, if you're buying an ETF, you can't really buy it in partial shares for a lot of different investment platforms. Mutual funds sometimes have minimums, like you have to put X amount of money into a mutual fund, but there are a lot that you can just buy in whatever increment you can just to get money into the market. So you've decided on your index and which one you're going to buy. I personally buy a lot of ETFs. So let's talk about one specific example of this: the S&P 500 ETFs. So, again, to clarify, the S&P 500 is an index made up of the 500 biggest companies in the US, and an ETF is a share of whatever that basket is. There are going to be a ton of different ETFs that track the market in different ways, and you need to decide which one is best for you. I personally pick my ETF based on what has the lowest fees and what pays dividends the fastest, but people have tons of different considerations, and I'll put a link down below of a bunch of different ETFs. As a reminder, if you're investing in the market, especially an S&P ETF, does have a little bit less risk than picking single names, but at the end of the day, you are making an investment, and so it is still risky in some sense. There are days where I lose money, and at the end of the day, I have to be okay with that. Usually it comes back, but again, you never know, and that is an element of risk in the stock market. So here are the three biggest things I think you have to think about with index funds. Number one, availability. Can you trade in and out? If you were going to buy a bunch today, would you move the market dramatically because no one else is buying them? That's something I would think about. Number two, fees. I'm always a fan of picking things with low fees, but again, you have to think about what that means. And number three, how closely does it track the benchmark? You don't want an index fund that's not from a reputable place, where they don't have the ability to track the market really well. And honestly, the next step is to buy. Again, think about the risk, think about the long-term things. But that's the very basics of how to start investing in the stock market. Even if you don't have a ton of money, or you don't have a ton of money that you think is long-term money for you, the way that technology and trading online now works makes it so you have the ability to start investing and start thinking about the stock market and your long-term financial goals. That's really important and something really exciting. That's definitely more recent. And so if you have the ability, I hope this helps you start taking advantage. I don't do a ton of day-to-day trading. I don't trade in and out of my portfolio on a regular basis. I don't even check my portfolio on a regular basis. I put money in there and hopefully I let it sit and it grows in the long term. And that's something that thus far has been proven to work. Until next time.